If you're buying a first home soon, here's something you really should consider. House prices might go down, and interest rates, they might go up. In fact, I'll guarantee you over the lifetime of your mortgage, you'll have an interest rate increase. But that doesn't mean you shouldn't buy a house. That doesn't mean you should just rent forever, because you might lose your job, so I should just rent. You might have a baby, so I should just rent. All those things could happen regardless of if you're renting or buying a house. It just means that you should have an emergency fund. When you buy a house, don't put in all of your deposit, have something left out just in case. It also means that you have contingencies. So, for example, you don't use all of the bank's money that they want to give you. They'll give you a max that you could get pre-approved for. That doesn't necessarily mean that you should take all of it. The other thing you need to keep in mind and take comfort from is that the bank assesses your mortgage with a lot higher buffers than you might. So, for example, they're going to test your mortgage at a 6.85% interest rate at the moment, even though with a 20% deposit, you're only going to get a 4.5% interest rate. And even then, they still want you to make sure that you have at least $500 to $1,000 left over after they factor in your income, your usual expenses, and your new hypothetical mortgage. So yes, house prices could go down and interest rates go up. But if you're buying a home to live in, and you don't need to sell it immediately, then you're going to be okay. The only times that I see people get in trouble is when they don't plan any big financial positions, or they decide to have a child and haven't factored in the loss of income that comes with that temporarily.